until we have a vaccine, what we've seen in other markets, the consumer is still going to be concerned about safety. They're going to be making kind of this unconscious cost-benefit trade-off. We do need a vaccine. I think certainly our expectation, though, is that a vaccine is probably, call it 12 to 18 months away.
Welcome back to Fast Money. That was McDonald's CEO Chris Kempczynski on Mad Money last night, raising his concerns about getting fully back to business until a COVID vaccine comes out. But here's a question. Does that 12 to 18 months even matter as long as the Fed is in play? Chair Jerome Powell today again saying the Fed will keep its, quote, foot on the gas until it is clear that the economy is on the mend. So why can't we just get on board here, Guy, and ride this train? I mean, we know the Fed is going to do everything in its power, use its entire balance sheet to keep this economy going until we get that vaccine out, at which time business will pick up.
Yeah. No, listen, that's fair. And it's made a lot of people a lot of money. Tim has correctly said, don't make this more complicated than it has to be. The pain trade is higher. A lot of people, a lot smarter than I am, say don't fight the Fed. It all makes sense. But it shouldn't be that simple. There has to be some ramifications. And we're 12 years into this. So I wonder aloud, at what point do we hit the point of diminishing marginal returns? Now, clearly, I thought it was a while ago, but I think we're headed there. The Fed can only do so much. And, at some point, the market's going to call BS on them. And I'll point this out as well. If the dollar has some precipitous drop, which I'm not suggesting we're at the precipice of, but it certainly appears as though that there's been a sea change in dollar sentiment, that's not particularly bullish for equities, in my opinion, despite what history might tell you.
All right. Well, our next guest says the Fed could actually be the biggest risk to stocks right now, and that the broader economy could also be in trouble. Sven Henrich, founder and lead market strategist of Northman Trader, joins us on the phone. Welcome, Sven. It's always great to speak with you.
Hi, Melissa. Thanks for having me on.
Why is the Fed ultimately the danger, and when will we see that point in time?
The Fed really has created a massive asset bubble here in the last few months. The lender of last resort has become the lender of the entire resort, and no red line shall remain uncrossed. The Fed has basically created a gambling casino at this point, and all the gamblers have moved in. From my perspective, the danger here is that the Fed is overdoing it and zombifying the economy. They're in process of inserting itself ever deeper into markets. And that makes the Fed itself of becoming too big to fail. And the Fed losing control over the asset bubble is now the biggest risk factor to the economy. Remember, Alan Greenspan several times had already mentioned, if markets drop 10%, that impacts GDP growth by 1%. And so now we've had this massive rally, which still could be a bear market rally, by the way. And, asset prices have reached levels that we've rarely ever seen. And let me give you two examples here. One is market cap to GDP, and I know Guy has mentioned this on the show before. There's only been two periods in history where markets exceeded so far or disconnected so far from the economy that it's reached level of 150% and higher. One of those times was the NASDAQ bubble in 2000, and the other one, ironically, was the February 2020 top, because obviously the Fed had already printed significant amounts of money in 2019 with their repo operation. So we ran into this COVID crisis massively extended from an economic perspective. And so now we're here now, and this is really fascinating. Last week, June 8th, we actually hit 152% market cap to GDP. And just to put this in perspective, typically what you see inside of a recession is that there's a discounting process for assets. And actually in 2000, 2007, we dropped to 50% to 75% market cap to GDP. So to be inside of a recession and at these extreme market valuations we've never seen before, and congratulations, I guess the Fed just managed to do something unprecedented, manufacture the first asset bubble inside of a recession.
Dan, you got a question?
Yeah, so Sven, let's just say the Fed is this bridge, right, to a vaccine. That's how we started this conversation. I guess barring some horrific second wave of the virus and some really bad news as far as the pace of a vaccine or therapies, what do you think the downside is? I mean, the Fed told us this week with the corporate bond buying. I mean, they're just going to keep pulling things out, and I'm kind of like, shruggy emoji here. So for me, worst case scenario, I see 2,600 downside in the S&P 500 in a bear market here.
Yeah, I don't disagree with that. I think we're not going to see a massive fast crash like we just saw in March. There's too much liquidity in the system. But we are definitely open for sizable corrections here in the next few months, especially if we do not get the type of V-shaped recovery that I think a lot of people are at the moment presuming. And the valuation risk is so high and the multiple expansion risk is so high. Specifically, what I maybe want to point to is that in the last 3 years, really, we've done, in terms of the market, repeat the same patterns over and over again, which is all rallies have come on either monetary or fiscal expansion, and all market drops have come at the point when basically fundamentals have reasserted themselves. And let's face it, the big picture here is that the market moves have become ever more extreme. The rallies to the upside as well as on the downside. Last week was a good example, right? Because all of a sudden there was a quick drop of 10%, 15% on the small caps, for example, in just 4 days. Why? Because these markets are building these compression patterns on the VIX, and the rallies are so steep with so many overnight open gaps that these gaps never fill in many sessions, but technically they want to revert and fill those gaps. And for that reason, actually, knowing there's so many gaps still below 2,700 all the way down to 2,400 is a lot of open space from a technical perspective.
Sven, it's always great to speak with you. We hope you'll come on again soon. I'm
Thanks,
sure this
Melissa.
is a conversation that will continue. Sven Henrich of Northman Trader Group. Karen, what do you think?
Well, I think, so definitely the Fed's there. That's been driving the market, of course. We know that. But it's interesting. I mean, Powell says over and over and over again, he needs additional help, right? He wants fiscal stimulus as well. So, I think we'll get that, which will just allow this sort of bridge to be built out a little longer. I don't know if it gets us all the way over the chasm of what COVID-19 causes, but I mean, until then, I think there's kind of a floor. I just don't know that it's an at-the-money floor. So this kind of market, I find it very difficult, and I don't find things that I really want to buy.